Leverage trading is a common strategy in financial markets, but it carries significant risk. Let's break down how it actually works. At its core, leverage means using borrowed capital to increase the potential return of an investment. A 2-to-1 ratio means for every dollar you invest, you borrow another dollar from your brokerage to increase your position size. To use leverage, you need a margin account. The broker charges interest on the loan, and your existing assets serve as collateral. Cash trading is limited to your own balance, while margin trading amplifies your buying power at the cost of interest and higher risk. Leverage works both ways. A small move in the underlying asset is doubled, meaning your gains increase, but so do your potential losses. Most experienced investors treat leverage with extreme caution because it can deplete an account balance faster than cash trading. Understanding the mechanics of margin is essential before considering any advanced strategy. Thanks for watching, and subscribe for more basics.